Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today, once again, I'm joined with my friend Doug Heagren. Hey, Doug.
Hey, Kirk, good morning again. It's becoming a pattern. We've been hanging out so much lately.
Hopefully, your wife doesn't start asking questions, Doug.
She
Don't
might.
don't ask, don't tell. All right. So anyway, let's just get cracking at it. So this week we had well, actually last week, because this is coming out on Wednesday, we had the Federal Reserve raise interest rates by 75 basis points. So we're between 3 and 3.25%, which is not a surprise to anybody. But it's still higher, and obviously the trend is in that direction. So, Doug, when you see the rates rise 75 basis points, kind of like what comes to mind for you?
Well, I'll tell you what comes to mind. It came right out of Powell's mouth. I think he invoked Volcker's name 4 times in 8 minutes, and that tells you tells you what he's focused on. And I think that the takeaway from Jackson Hole that I got, not only from my own interpretation, but listening to some experts out there that include Bob Stein of First Trust and some other really solid economists, is Volcker's mad. He's really mad right now. And you know what he's mad about, Kirk? He's mad that nobody was taking him seriously. I'm sorry, Volcker. I meant to say Powell, but hey.
Powell would appreciate that.
Yeah, he's mad. And he's mad about the fact that nobody's taking him seriously. So here's what happened, right? He started to raise rates, said, we want to fight inflation. Okay. And he started to raise those rates. And then what happened? Things started to soften a little bit. And he started to get this almost this disbelief that he was going to follow through with what he has been clearly telling us as a mandate, that I'm going to do everything I can to blow everything up if I have to stop demand and stop inflation. And then what happened? All of a sudden, the economy started to soften a little bit. Markets started to go down. And all of a sudden, the bulls came in because I thought, yep, here's where it goes. Government's going to lower interest rate again. They're going to have to, right? Because it was, transient. But here's the reality of it. That's not what he believed. It's not what he's been saying. It's not what he's going to do. And so I think, when he came out in Jackson Hole, he came out angry against what he believed to be people ignoring what he had to say. And what he has basically said is he is not going to repeat the 1970s and 80s here, because what happened? Okay, everything started to slow down, so they'd lower interest rates, and then inflation would heat up again, so they'd raise interest rates, and then all of a sudden it would start to turn, and they'd lower interest. It was this constant chase battle. He's not going to chase it. He is going to he's going to raise interest rates until we go into a recession. He's not going to admit we're in a recession until we are well in a recession. And you know why that is? Because he doesn't want to be caught chasing the rate game like they did 20 years ago. He's clearly watching what happened with Volcker and stagflation, and he is making his message loud and clear, even though bulls want to jump in. We're going to be running it. He's going to continue to attack inflation, the economy be damned. And I think from what I'm hearing, that over the next couple of quarters, we're going to see another rate increase, maybe 75 bips before the election, potentially even another 50 after the election in December. And then you go into 2023, we're looking at potentially another 25 bips if we haven't completely tempered inflation. And this economy, by the end of 2023, 2024, there's from what I've seen, about a 90% agreement that we're going to be in a recession, a very harsh recession by the end of next year, if not early 2024.
Yeah, no, I appreciate that, Doug. I think what's interesting is, just like you said, the market has a big disconnect from what the Fed is seeing or trying to influence. And the Fed is trying to influence a recession. Unfortunately, they use Fed speak, so most people misinterpret it, even though they know exactly what he's saying, right? That they're trying to reduce demand. Well, that's a recession, right? When you're reducing demand, you're creating a recession, right? But that's their methodology of slowing down the economy. Now, what I find interesting is just like you said, is no one's really paying attention to him. He wants to be Volcker. He doesn't want to be Burns, but people are not paying attention because they think, oh, well, just bail us out as soon as we hit a recession. And the fact that he's angry that people are not listening to him, he should be. I mean, he's frankly, it's his fault. I mean, that's his job to communicate the message. But if he doesn't take this path, then we are going to be in trouble. I think we're going to be in trouble anyway, but I think we'll be in a lot less trouble if we're able to kind of manage this transition. But right now, everyone thinks that everything's fine. And this is the thing that actually I'm mad about, is that nobody's respecting where we are. The market is not pricing in a recession. The market is not pricing in high inflation for extended periods of time. The market is pricing in, hey, by the end of the year, the rates are going to start dropping and everything's going to be fine and all be sunshine and rainbows. That's what the market's pricing in. The market is not pricing anything in. To me, it's just caused me to scratch my head, because there's a lot of smart people doing really stupid things. So, if I was an institution, I'd be treating this like, hey, we got a free gift here, is that the markets are giving us a free pass to do whatever we need to do to prepare for worse economic conditions. And I guarantee there are people out there that are actually preparing, but most aren't. I mean, look at the first half of this year when the market was down 20 to 30%, depending which market we're talking about. Even bonds were down a lot. So when you have that happen and people are just like, oh, it'll go back to normal, it's only 20%, it's just a speed bump. Frankly, I think we got another 20 to 40% down. And and I think I'm being nice, frankly. So we'll see what happens. But I do agree with you. I think Powell is going to get caught holding the bag, and he'll get the blame for this, even though he has been communicating this, quite obviously to just about everybody who's paying attention. So let's move on. There's a chart here that you sent me, Doug, which I thought was great, and it's the price change chart. And I haven't seen this chart in a while. It's from 1996 to 2016. So just want to point this out for those watching YouTube. Once again, we're a little slow on our videos, but we are going to start getting them up. So those of you, please bear with us. But basically, it shows the price changes in the last 20 years. Now, if you look at the bottom of the chart, we've got TVs, which have decreased in price significantly over the last 20 years. And on the top end, you have college tuition, college textbooks. Now, we all know the cost of college is going way through the roof. Another area that's high is childcare and healthcare. And then you have the middle, you have new cars, household furnishing, clothing. But you have a lot of technology, TV, software, toys, cell phone services declining over the last 30 years. So I point this out just to show that we all look at the CPI as a number. And 2 weeks ago, the CPI came out and it was 8.3, which I think surprised a lot of people. A lot of people thought, oh, well, it's just going to go back down and everything will be fine. And that didn't happen. And it surprised a lot of people, which is why the market's down at the moment. I think that the market's probably going to, we're probably at a floor at the moment. This is Friday when I'm taping this. And I think we're probably at a floor, and then we'll probably bounce a little bit. I think we're probably a little range bound. But if not, if we break through this, it's going to be a short but long ride down. So I think people should just be mindful of that and just manage your risk. We talk about that all the time on the show. Manage your risk. If you're not doing that, then you're really not investing. But if you look at this graph, though, what I wanted to point out was the fact that there's such a deviation between many different types of goods and services. The fact that in the last 20 years, college tuition's gone up about 200%. And in the last 20 years, TVs have gone down around 90% in terms of price change and value. So there's a huge difference there. But yet, and there's obviously a range between those two extremes. But the point is you get that 8.23% by adding in all of these different things together to get the aggregate number. So even though it doesn't feel like 8.3, that's because there are things that are like 15% and there are things that are 0. And the average comes out to 8.3. Now, I think a lot of us who've stuck around numbers a long time and seen a lot of these inflation numbers know that 8.3 is kind of a comical number. There's no way it's 8.3. However, you have to look at how the calculations are actually done. And if you're looking at the calculations, it is an accurate number. I know people always complain about it, but ultimately it depends on what you're measuring and how you're measuring it. And so rather than, kick and scream that the numbers are wrong, just look at it and say, all right, what can I use as a measuring stick to measure what inflation is? And if you're sending your kids to college, that's an important part of the puzzle that's maybe not being accounted for in the way that it is in your life. So just be aware that the CPI does not reflect your life. It reflects a basket of goods and services that's aggregated among hundreds of millions of people in our economy. So while we don't agree necessarily with the calculation, it is the calculation everybody uses. So what are your thoughts on this, Doug?
Well, I think the big takeaway there is, you may not have a child in college, but what is the key takeaway here is there's, and I kind of mentioned this last time, is there's the needs and wants, right? So the CPI is taken into consideration lots of necessities. It's also taken into consideration a lot of discretionaries. You don't need to go out and necessarily get a new TV. You don't need to go out and necessarily buy new toys. You don't need to go out and necessarily buy new clothes or household furnishings, but you do need to have housing, and you do need to put food and beverage on the table, and you do need to take care of healthcare. And for many families, they have to take care of childcare. So when you start to look at those things and you look at the overall CPI being in the 8% range, but then you look at, it's like, but I'm not buying any of those things that are declining that help to offset the average and bring it down to 8%. So your real household inflation could easily be 12 to 15% right now, which is why when you say, well, it feels so much worse than that, it might be for you. The other thing to keep in mind, you talk about, being accurate numbers. It is accurate numbers, but there is some interesting metrics that go on into those numbers. That, the U.S. government has changed the way they calculate inflation over the years from time to time, including housing, removing housing. Gasoline prices go up, but they're not included in it because they feel, petroleum is already used in the various layers of manufacturing that already occur on goods and services. But the thing is, you also have to remember from the government's perspective, inflation is not only just a metric of what you're paying, it's also a metric of what the government's going to be paying, right? So when you think of cost of living adjustments on government pensions or on Social Security, one of the things that they're looking at is how they calculate that CPI also impacts how much more they're going to have to give you in those paychecks and those obligations. So if you don't think there's a little bit of self-preservation that's gone into those calculations over the years, I mean, I don't want to be a conspiracy theorist here, but when you're going to be paying out based off of that, there's definitely got to be a little bit of a metric or a little bit of self-concern as to how you look at those numbers to try to temper out what your future obligations are going to be when you look at the budget on some of those entitlements.
I know you love the show. I do get a lot of love mail and hate mail from people who listen to the show. I certainly prefer the former, but I have a thick skin if you want to send the latter. However, I do need to ask you a favor. We're looking to expand the show with a lot more resources and high-end guests. You're going to love what we have in store for you in the upcoming months. However, now I need your help. I need 5 to 10 minutes of your time to help influence the direction of the show. We're doing our annual listener survey to help understand our audience better. I know you're busy with your life. Well, I am too. My kids are going back to school, and that leaves me less time for other things. But as a listener of the show, I could really use your feedback. I'm not the government, so I'm not asking you to work for free. So in exchange for 5 or 10 minutes of your time, I'm going to give you a gift of over 100 million Zim dollars. That's right. I'm giving you a gift of over 100 million Zim dollars in exchange for 5 to 10 minutes of your time. Go to moneytreepodcast.com/free money to get your free money today. All right, well, let's move on to a new topic here. So there's one thing that's come up recently, and I've been an advocate of 0% bonds for a number of years because interest rates are zero and the risk was really high and you weren't getting paid for your risk. So I've been an advocate of having no bonds in a portfolio for a while. However, now interest rates are actually starting to get interesting. And so I wanted to point this out because, just like anything else, I advocate for certain things at certain times, but then the facts change. And when the facts change, you got to change your mind. So I don't think we're there yet with bonds, but I think it's worth looking at because if you've been like me and you've pretty much ignored bonds for the last 5 years, you need to dust off your bond analysis gear because it might be a little bit rusty. Well, I think what we're seeing now is, we're starting to see interest rates. You can start to get, 3 to 6 month treasuries at around 4%. And, depending about 3.5 to 4%, depending on your maturity. But let's call it 4% to make the numbers easy. When you're starting to get 4%, when's the last time we saw that in bonds? And this is treasuries. This is not like corporate bonds where you get a little extra percent here and there for taking risks. This is US treasuries. This is as guaranteed as you can come when it comes to bonds. So, when you look at treasuries and you look at the rates you're getting, I mean, those of you who, by the way, who are not investing in savings bonds, I highly recommend looking at. If you go to US Treasury Direct, you can put up to 10,000 a year into, I think they're around 9.3, somewhere thereabouts. You have to correct me, Doug, but the US Treasury Direct, you can put up to 10,000 a year per person, and it's like 9.3% a year interest. That's actually coming up for renewal. It's about every 6 months, and October is the renewal date. So we'll probably see a new rate coming up in the next few weeks. So those of you who are interested, unfortunately, if you've got a lot of money, it doesn't work that well because you only put in 10,000. But it's better than a sharp poke in the eye. So if you can get that 9% plus on money that's virtually guaranteed by the government, then I highly recommend taking it. That being said, getting back to treasuries, they are getting to a point where things are getting interesting. And I only point this out because we're not there yet, but there's going to be a point in time, probably in the next few years, where you might even see 8% treasuries or 10% treasuries. And maybe it's even higher, right? Like you look back in the 70s and get up to got above 15%. Well, if you throw me a 15% 30-year treasury, I'll give you all the money I have, and then I'll double it, right? I'll borrow money from everybody under the sun. That's a darn good rate. And you're not going to beat equities equities are not going to beat that in performance over time. 15% a year. It's just not going to happen. So while I'm not an advocate of bonds right now, I am an advocate that each one of you should go back and look at bonds and start to understand how they work and look at them for your portfolio. Not yet, right? I'm not suggesting yet, but I am suggesting that you at least start to follow them, because rates are starting to creep up to a point where it's like, okay, I could buy a 6-month treasury or 6-month CD at 4%. That's better than cash. It's better than earning nothing. So I just mentioned that because I think a lot of people are going to miss this because rates are going up, and bonds are highly dangerous when rates are going up. That's why I'm not suggesting you get in right now, because we're not close to that point. But you should understand how they work. So what are your thoughts, Doug?
Well, I think one of the things to understand too is that bonds are kind of like stocks. They're one of those things where somebody, a lot of people throw out the term and kind of group everything into one thing, and it gets a little bit confusing for the general public. So I think if we're talking about bonds right now, there's a lot more that needs to be understood into what that means. So generally speaking, when people are talking bonds, they're talking things like, the AGG ETF that's out there, that's typically going to be part of a 60-40, general bonds. And you're generally going to be thinking long-term duration. The key here is duration risk, right? The longer you're locked into a bond that's going to be paying a yield, say 20 years, then the longer risk you're going to have, the greater risk you're going to have right now as they're rising interest rates. And if you're going to simplify it the littlest way, it goes back to risk-free rate versus having risk. If I've got, for all intents and purposes, let's say I can get 2% in my checking account, and I could get, 10% in a bond, or let's just say 5% in a bond, 20 years, and you're seeing that interest rate in checking accounts go from 2 to 1, the people are going to be willing to take some risk and buy into bonds that are paying 5% because it's better than what they're getting. They know that there's some default risk there, more than your check account, but it's worth it because of the spread. Now, what's happening this time around is you're seeing interest rates go up. So if you're locked into that 4 or 5% long term, and all of a sudden interest rates short term are going up, and shorter term bonds typically are going to have less default risk than long term because they're getting in and out. But you're going to be saying, wait a second, why would I want to be locked into 20 years of 5% when I can get better yield short term and get in and out of that than be locked into something long term? And that's why they go down. Now, a lot of that, bonds getting impacted negatively there's a premium in the beginning. When rates start going up, you get the biggest impact on bond values up front. A lot of that froth has already been taken out. Okay. So as the Fed continues to raise interest rates, you'll start to see, you're already starting to see a lessened impact on bonds. And I think the key thing in a rising interest rate environment is that duration thing. So under 3 to 5 years is a much safer place to be than long term. But we're starting to, and again, I like what you said, I wouldn't get into yet, dangerous. We're starting to get into a point where durations may come back into play. And if we start getting into 2023, 2024, and we start bottoming out and the Fed starts looking at cutting rates again to try to temper a recession, we may start to see those durations come back into play. But also keeping in mind, like I said before, bonds are used generically. Typically, what you're looking at is treasuries. Typically, you're looking at corporate bonds. Typically, you're going to be looking at, maybe some tips in there. But there's other types of bonds. You've got municipal bonds. You've got preferred stocks, which kind of act like bonds, and other things that are out there too. So from a standpoint of impact, I mean, I think there's places with short duration where fixed income can still be can be protective, especially through market volatility. I think there's alternative types of fixed income instruments that could still be at play. But what Kirk is saying here very clearly is, if you're in your traditional bonds, or again, lots of people like passive investing, right, Kirk? They think it's the end all be all, which we're finding isn't necessarily the case when we start getting into more turbulent economic conditions. But it's been great the last 5 to 10 years. So most people, when they think of bonds, are thinking of like AGG, the ETF, passive. Bonds are not a place to be passive. They've never been a place to be passive. Even for those out there that like Vanguard, Vanguard has written white papers. Fixed income is not where you want to be passive. This is a time, and will always be a time, where you want to take an active understanding of what's going on in the fixed income space, because it's incredibly complex. And while it might be deemed as a safer place to be and a place to offset your stock portfolio, you really have to understand fixed income and the times in which the dangers can outweigh the benefits. And this is one of those times where bonds have actually fallen greater than stocks. And I think there's a lot more pain to come if you're not careful and you don't know what you're doing. Like you said, understand fixed income, understand what you're in, and be very, very cautious right now. And this is a great, great reason to have advice and active management around them.
Yeah, I appreciate that, Doug. And just one other thing to point out about fixed income. If you look back in the 70s, bonds actually did okay, even though rates were climbing significantly, especially in certain years where they went up a lot. But you'll notice the returns on bonds were not terrible. In many ways, they were positive. And that's because you have a high interest rate. So let's say you're getting a 10% rate of interest on your bond, and bond yields are still going up, which means you're still losing money, right? The bond value is continuing to lose money. However, you're getting 10%. That's a big cushion. So maybe your bond only lost 7%, but you got 10. So that means you're still positive by 3. And I think that's what I mean by having bonds in the portfolio. Is typically, I don't look at them this way. I look at them as, hey, this is a total return. The capital appreciation should be pretty good, or at least in the last 20 years. And then you get a little bit of extra interest. But now that interest is really a buffer. So if you look at dividend stocks, they characterize the same way. If you look at the 70s, when returns were not all that stellar for bonds or stocks, but the best performing assets during that period were ones that were producing good income, whether it's dividends or whether it's interest. But you have to just recognize that cushion is what's going to keep you steady during those times where, especially if you're a buy and hold investor. I'm not advocating the buy and forget investor strategy, but I know some people do it. And honestly, for some people who don't know any better and don't have any access to advice, it's not terrible, but you should just understand that it's obviously a risk. But even for those people, you're going to do a lot better during those times, because you're going to have that cushion to support the rocky times that inevitably we're going to see. Also important to recognize that when you go from 0% to 1%, the negative returns you get are significantly more than if you go from 14 to 15%. And, there's a chart we have that we share in some of our webinars that show the grid of change of interest rates from, 0 to 1, 1 to 2, 2 to 3, all the way up to like 15 to 16. Well, 15 to 16, it's a small change compared to, 0 to 1, which is actually ends up being a big change. So I think it's just important to understand how that plays out and how that impacts your portfolio. As I'm sorry, I'm looking at it here. If you go from 1 to 2%, it's a 24.6% difference in return. So you lose a quarter of your money in bonds if it goes from 1 to 2%. However, if you go from 14 to 15%, it's only 7% difference. So there's a huge difference. And just to underline that, once we get to those higher rates and rates are still going up, then you'll be insulated by that, hypothetically 14%. So you lose 7, but you made 14. That means you're positive 7. So I know we're getting close to wrap it up here, Doug, but you got some other areas you wanted to talk about today that are a little more fun.
Yeah, well, we're going into the election cycle, as I mentioned earlier, and I know that people are kind of always thinking about what's going to happen here in November. Just a couple things. Look, we're not taking any political sides here. We never do. I mean, it's just kind of looking at the data. And just what seems to be some prevalent thought out there is that there's a high probability of the House potentially flipping over to GOP in November. The only reason is if you look historically at presidential approval ratings, there's a high correlation between presidential approval ratings and the House changing. And right now, unfortunately, his approval ratings have come back, but Biden's approval ratings are low enough that, according to the correlated history, that would typically indicate a change from the House. Now, the Senate's probably going to be a little bit less likely to flip, although there's maybe about 55% chance. The issue right now with the Senate is, of course, the House is always campaigning every 2 years, right? You have to turn it over, but there's only 34 Senate races that are coming up this year, but the Republicans hold 20 of those already. So a lot of those there's a couple of them might change, but for the most part, the incumbents look pretty solid to win. So which means that there's only about 14 Senate seats right now that are up out of all the 34 races that aren't already held by the GOP, which means there's about 14 Democratic Senate seats. That's not a lot of seats that the GOP could potentially take. So, at the end of November, I mean, based on what it looks like right now, if nothing changes, we might have a House flip over to GOP. Senate's kind of a coin flip. And I think it's going to be some interesting races to watch there. Regardless of what side you're on, to take seriously with regards to this. Now, there is a little bit of a question as to whether, going into the presidential elections coming up, whether or not Biden is going to kind of run for president again. And then that, of course, will throw into a lot of turmoil there. So that's a little too early to look at to see what's going to happen. But, obviously the House and the Senate are going to be interesting over the next couple of months. And of course, along with the Fed, could create some interesting turbulence. If you're in that boat, take your motion sickness pills. Now, on a totally different type, we talked about inflation. We talked about college. I just wanted to say something. You talked about at the top of that chart, college was one of the most expensive things. One of the questions that I'm getting, because again, as I've mentioned in previous shows, we do a lot of college planning. There are questions around, well, what's happening to inflation with all of the money that's, all of these loans that are now being forgiven. Don't see a lot of impact to that. It's just not all that much money that's going to be forgiven from an overall monetary impact. However, this is the thing that we see as a bigger concern. Okay, they've also implementing a new rule that there's only going to be a 5% cap of your income in terms of what your payments on loans are going to have to be. So you start thinking about these kids that are going to college and they might come out into a degree that doesn't pay very much. And the colleges are going to be in a great position to say, hey, look, come here, pay whatever, because you're not going to really have to pay that much in loans. You'll never pay them off, but your 5% to income ratio is really low. Come pay us what we want. And I think there's a concern here of an encouragement of these colleges to entice even more students that may not necessarily be qualified, or maybe college isn't the right path for what they want to do, to now go to college, take out these exorbitant loans, it ultimately, under the guise of you don't have to repay them. I would call this a little bit of the college money laundering, in my opinion, because I think it's going to put a lot more money into the coffers of these colleges. And they're going to use these new rules as a way to continue to get more people in, which creates, we know economics 101, supply and demand, more students applying to those college, more loans being taken out. That's going to go right into the coffers of those colleges without any real thought as to the impact of not only our economy, but also the impact of those that are taking out those loans. So, to me, that's the bigger concern than forgiveness of any of the loans that already exist. Is now what are these new rules going to do in terms of enticement for colleges to just get, to encourage kids to take out even more loans they probably shouldn't be taking on a path to college that may not even be the best fit for them in the first place. So really interested to see how that's going to go.
Yeah, and frankly, when you're describing it, it makes me remember back at the early 2000s up to 2008, where pretty much the politicians incentivized the lenders to loan out money to everybody because everybody needs to own a home. Well, no, not everybody needs to own a home. People rent too. There are renters, and renting is not a bad thing. If you need to rent, then you rent. I'm renting. I'm not ashamed of it. I want to rent. That's a choice, right? So it's not a bad thing. Everybody doesn't need to own a home, just like everybody doesn't need to go to college. I'm not saying they shouldn't. I'm just saying you don't need to. There's plenty of people who've been successful who didn't go to college. There's plenty of ways you can get an education without going to college. Yes, it does help. It's harder if you don't, but frankly, the ROI for going to college right now is negative. So the money you're spending, you might as well just light it on fire, because you're spending 50 grand for a degree in underwater basket weaving or women's studies or American studies or whatever they're selling these days in college. And you come out and you get a $20,000 a year job and you can't pay your loan because you're not making enough money just to sustain yourself. I mean, 20 grand isn't enough to rent an apartment and to eat and to go out and have a good time as a young adult. So yeah, you're going to somehow pay that back? No. So I think people need to just square their priorities a little bit. But this reminds me of the housing problem back in the early 2000s when everybody needed a home. Oh, well, let's just give them free money. Let's just give them 0% variable rate. And oh, don't worry, that rate won't go up. It'll just stay low because it's variable and because we have low rates, as if somehow that's not going to change ever. Now, granted, we did enter a period where rates were zero for 20 years, but you can't expect that, and they're certainly not zero now. So the point being is that that's one of the reasons that we had the housing crisis, because too many people had a loan that shouldn't have, right? People shouldn't have 10 houses if they're not making payments. So I think we're going to start to see that here with college. It's going to be the same problem, and people are going to say, "I don't understand what happened. The whole student loan crisis blew up, but I don't know what happened." And these would be politicians. I'm pretending like I'm a politician here. Oh, what happened? I didn't understand this would happen. I didn't understand economics. Why should I understand them? I'm only a politician, right? So that's what's going to happen. And then people are going to point fingers at other people, and they're going to point it at Wall Street as if Wall Street's the problem. Everybody's the problem. We all know it's a problem. We all know everybody's got their hand out, especially the colleges. And the colleges don't care, because if people don't pay back their loan, they don't care. They got their money. And, it's a little bit unfortunate when you have, places, and I'll pick on them, like Harvard. It's the largest, second largest nonprofit in the world, behind the Roman Catholic Church, but certainly the largest when it comes to college endowments. And yet they're still charging people for a college education. At what point do you just say, all right, that's a bit excessive. You need to start paying your taxes. So we'll see. We'll see what happens. I think there's going to be a big blow up, and we all know it. We all see it coming, and no one's bothering to fix it. So, Doug, final thoughts from you. Where can people find more about you?
Oh, thank you, Kirk. Yeah, you can find out more about us at ProCollegePlanners.com. Talking about this whole college thing. 2024, the rules are changing. They're changing a lot of the metrics around how to get money for college, what it's going to cost for you. I mean, it's a politician came by, said, "Hey, I've got a good idea. This thing needs to be changed." And then he changed it in ways that's basically going to create a more difficult path for lots of people. But there are ways to get your costs. Look, college isn't for everybody. There's trade schools. There's no school. There's junior colleges. And then there's four-year colleges. If you're going to go to a four-year college, make sure you're picking the college based on the right fit, academically, financially, and socially. Where can you actually go to college where it's going to be a return on investment, where you're going to get a degree that's going to create an extraordinary future for your child? Most of what you've been taught, most of what you listen to, most of the way they teach about college is wrong. And unfortunately, look at the numbers. You can see the results of bad advice. So reach out. It's good. ProCollegePlanners.com. We've got a free report called the CAP report that'll tell you right now kind of what college could cost for you at your top 3 schools, some suggestions of schools that might be a little bit more favorable economically. And then maybe we have a conversation with us so we can find out exactly what is the right path for you, what your challenges, what your frustrations are, and ultimately help you make the right choice with college, because it is definitely a great path for the right people, but go to college for the right reasons at the right price.
Great. Well, thanks again for coming on the show, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.